Today, we are peeling back the layers on Pinduoduo's latest earnings report. And let me tell you, what we're about to uncover is a story that is way more complex than any of the headlines would have you believe. So, at first glance, the news for PDD looked absolutely incredible. The company didn't just meet Wall Street's forecasts. No, it blew right past them. The stock price soared, and it really seemed like it was all good news. But what if I told you that when you look past those headlines, the numbers tell a much more dramatic story? One where that good news is actually hiding some really serious challenges. So what is actually going on here? Okay, to get to the bottom of this, we're going to deconstruct that deceptive earnings beat. Then, we'll uncover the truth that's hiding in the numbers. We'll see exactly why PDD is trading profit for ambition, how its global plan just slammed into a massive American roadblock, and finally, why Wall Street is making billion-dollar bets on both sides of this very story. So, yeah, the headline numbers look great, but they were hiding a pretty troubling secret. The company's main business, well, it was getting much worse at actually making money. First, here's the number that everybody saw, 7% revenue growth. You know, in a tough economy, that sounds pretty solid, right? But here's the catch. It's actually PDD's slowest growth rate ever recorded, if you don't count the very beginning of the pandemic. But here it is, the first major red flag. The profit from their core e-commerce business, the main engine of the company, it didn't just stall, it plummeted by a staggering 21%. That is a huge drop. And it means that main engine is making far less money. And this might be the most alarming signal of all. The actual cash being generated from their day-to-day operations, it was cut in half. It dropped over 50% from the same time last year. So the big question is, how can the headlines be so good when the financial engine of the company is sputtering like this? So how can revenue look okay while the core business is just bleeding profit and cash? Well, this wasn't an accident. It was a really clever bit of financial sleight of hand. Let's break down exactly how they did it. To really get this, we need to look at something called operating profit. Just think of it like a company's health meter. It totally ignores all the financial noise and it just asks one simple question. Is the main business, in this case selling stuff online, is it actually profitable? And as we just saw, PDD's health meter was flashing bright red. Now, this is where it gets really interesting. This is how PDD papered over the cracks, while their core business profit fell by almost 6.8 billion yuan. A very conveniently timed gain of 5.6 billion yuan from their investments, which is totally unrelated to e-commerce, magically appeared on the income statement. This financial gain masked about 82% of the collapse in their core business profit. And this slide really shows the disconnect. I mean, look at this. A year ago, PDD was a cash machine. Every single dollar of profit brought in $1.37 in cold hard cash. This quarter, every dollar of profit only brought in 70 cents. They are booking profits that are not actually hitting their bank account, and that, my friends, is a risky game for any company to play. So, why is all of this happening? You have to understand, this isn't a story of failure. No, it's a story of a deliberate, high-stakes, and incredibly expensive strategic choice. And you don't have to take my word for it. Management has been completely open about this. They are telling investors, in no uncertain terms, that they are intentionally sacrificing today's profits and cash flow for a much bigger prize down the road. And here's the key takeaway. PDD is really two different companies right now. Their Chinese e-commerce business is an absolute cash cow, still growing nicely. But their international business, Temu, has completely stalled. So what PDD is doing is taking the profits from China and pouring them into a massive, expensive war for global domination with Temu. But that global dream, the one powered by Temu, well, it just hit a massive wall in what was supposed to be its most important market, the United States. You see, Temu's entire US business model was built on this one rule. It was like a golden ticket. It allowed it to ship ultra-cheap items directly from Chinese factories to American consumers without paying any import tariffs. This gave it a huge price advantage. Well, in May of this year, that golden ticket was revoked. And the moment that tax advantage disappeared, the impact was immediate and just devastating. Temu's main weapon, those rock-bottom, tax-free prices, was gone. And American users, they vanished. Monthly users dropped 28%, and daily users, their most loyal customers, collapsed by 35%. This policy change has forced Temu into a truly impossible choice. Option 1, they can eat the cost of the tariffs themselves and lose even more money. Option 2, they raise prices, which completely destroys their main selling point. Or option 3, they can try to build a U.S. logistics network from scratch, a multi-billion-dollar gamble to compete directly with Amazon. None of these options are good. So you have a profitable core business that's funding a super risky global plan that just fell apart. This exact situation has created one of the biggest fights on Wall Street, with legendary investors placing billion-dollar bets on completely opposite sides. So the bulls, they see a visionary company with a $54 billion war chest using its domestic strength to conquer the world market, even if the U.S. plan failed. The bears, on the other hand, they see a company with deteriorating finances, throwing good money after bad into a broken strategy, all while refusing to return any cash to its owners through dividends or buybacks. And this isn't just theory. You can literally see the money moving in real time. In one corner, you have famed long-term investor Lai Lu, who just bought nearly $500 million worth of the stock. And in the other corner, at the exact same time, the growth-focused hedge fund Tiger Global sold their entire position. So that brings us to the crucial question at the very heart of this story. Is PDD's decision to sacrifice profit a visionary move to build a global empire, using its massive cash pile to just outlast everyone? Or is it a reckless, value-destroying gamble on a global strategy whose foundation has just cracked? The answer is going to define the future of this company, and it will all unfold over the coming quarters.